For the past couple of decades, you could kind of get away with not following inflation, whereas now, because there's such a disconnect between rates and inflation, is something that every person has to know. If you're simply failing to grow your wealth, then that's one thing. But if you're actively losing purchasing power with your money in the bank at a notable rate, that's a more serious problem that people have to pay attention to.
By owning a little bit is a good way to start that journey and to do a minimal portfolio allocation just to be aware of crypto.
The right number is not zero, and that it is something that people should be familiar with, even if it's a number that does not really impact their life. And realizing you own this, you self-custody it, you can send it to anyone in the world, and you're not going through a centralized third party. That's a really powerful technology. And then, of course, compared to other cryptos, it's the one that has the most credible decentralization. Some degree of diversification is helpful. I never go all in on anything, just for mental clarity, really. And so when something falls 56% in a couple months, it's literally you lose zero sleep if you manage your position size well and if you know what you own. I think this whole decade is going to be an interesting one. So there's the crypto part, and I think the ongoing underlying financial repression, currency devaluation theme is going to be with us for a while. But overall, I do think that this is a pretty interesting environment that's comparable to the 70s, comparable to the 40s, comparable to 2000s tech mania. So it is, I think, a pretty historic time to be in. When you have meme coins, meme stocks, there's a lot of landmines out there, but it's also stuff for the history books. Probably the takeaway I would have, and kind of the mindset to have, is be open-minded, but also skeptical.
The world is changing. Inspiration is everywhere. It has never been so easy to connect, share, and bring people together. We're learning from others and finding the best in ourselves. Challenging our beliefs. Sharing our vulnerability. Overcoming our fears. Transforming ourselves so we can transform the world. How far can we go?
This is London Real. I am Brian Rose. My guest today is...
This is London Real. I am Brian Rose. My guest today is Lynn Alden, the investment strategist, writer, and Bitcoin enthusiast. After graduating with a degree in electrical engineering, you spent over 10 years working for the Federal Aviation Administration before retiring early to focus on your passion, financial investment and advisory. Now, you run the Lynn Alden Investment Strategy Research Company, where you produce monthly financial analysis for hundreds of thousands of individual investors and financial professionals. Your research focuses on the volatile and changing market conditions of stocks, precious metals, international equities, and Bitcoin, with your work being featured in the Wall Street Journal, Times Money Magazine, and CNBC. Your ultimate goal is to remove the quote-unquote chaotic financial noise and provide top-tier research in plain English so that both institutional and retail investors can benefit. Lynn, welcome to London Real.
Thanks for having me. Happy to be here.
Great to have you here, Lynn. I'm looking forward to jumping in on markets, inflation, and Bitcoin as well. But maybe we start by kind of zooming out a little bit and just talking about investing, because it's not something that we teach people in school. It's not something that most people know much about. I had Robert Kiyosaki on my show, author of Rich Dad, Poor Dad, and he always tells the story. He raised his hand when he was a kid and said, "When are we going to learn about money?" And they're like, "Well, we don't teach you about money." And he said, "But you're teaching me Spanish and algebra and all these other things." And they're like, "We don't teach you about money." And most of the people that watch this show probably never got an education. And yet your story in your life is you, I think, taught yourself about money and then kind of retired early and do this as a passion. And I'm wondering, what are some of the basics that people should know if they even want to understand the mindset of investing, or even basic mistakes that people make? What can you tell people that maybe this is the first time they're thinking about this concept?
Well, probably, when you get down to the really basics, it's the idea of making more than you spend, and then finding a way to compound that in a relatively safe but still risk-taking way to exponentially grow that capital over time. And one story I like to tell is that, for example, my father had, he he was a police officer for a long time, and then he had a second career. So he was hardworking his entire life. He was working since he was a teenager. He had literally a perfect credit score. He paid every bill on time, and he just never built his wealth, right? So he lived in an apartment. He lived in a trailer park. He wasn't bad with money, but he just kind of was always just enough, right? And there's no like idea to like, put things aside and compound it over time. And so it's like if you miss one small thing, it can change everything else. And so my whole approach was to add that extra step of be good with money, but also find a way to compound it. And I think another big thing that people miss is they always focus heavily on ways to save money, which is useful. But it's also, I mean, I think a more powerful thing is find ways to make additional money, either by obviously finding ways to increase your career standing, right? So find ways to move up in your business, or by having a side hustle. And obviously that's becoming more popular today than when I started doing that, over a decade ago. We've kind of shifted more and more towards the gig economy. But it's still something that, if people did more of, I think they'd have an easier time once they really get going after maybe 5 years of that. It's like work up front, but then it's a lot more smooth sailing when they're more financially secure.
Yeah, it really is kind of a game of inches. You can either kind of be in debt, by a few grand every month, or you can try to be, ahead by maybe that same margin and then invest wisely and compound it. Puts you in two different scenarios when you're 10 years, later at 33 years old, like for you, for example. It really can change, I guess, your future if you're a little bit intelligent about the small pieces.
Exactly. Yeah, small things. And it is a shame that they don't teach it more in schools. It's kind of remarkable. I never learned it in school. You have like one in math class, they'll have a couple, word problems about compounding or banking and things like that. But other than that, you never actually learn personal finance. Like we learned all sorts of things. We learn like different types of jellyfish and things like that, but we don't learn how to manage money. And it's one of like the top five skills someone has to know in life, right? So managing resources is something that humans have been doing since the beginning. And money is just obviously our modern version of managing resources.
Yeah, you're right. Strangely enough, the only time that comes up is like in a math class when they're trying to explain the concept of what constant compounding, right? And so then they say, exactly. Oh, like interest. And you're like, what's that? It's probably our fault in England because, in Victorian times, it's kind of, I think, when they created the school system, and they created it for factory workers to give something for their kids to do, which basically they probably want them to turn into more factory workers. So a lot of that curriculum and even some of the systems and timings it's really antiquated. It's hundreds of years old and probably needs a revisit at some point. But you're right, it's just something that's not taught. And so many people, they seem out of place when it comes to understanding their own financial resources. And then you put in all sorts of, shiny objects like, free credit cards and all these other startups are kind of giving other free kind of credits, and people get down a pretty dark road pretty quick. And again, they're not necessarily bad people or not smart people. It's just financial education never came into their life.
Exactly.
Did it surprise yourself that you were able to, retire and do what you wanted to do kind of mid-30s? Is that what you always hoped and thought that was going to happen if you just kept to your discipline?
Kind of. It's one of those things like I had ambitions when I was young to do that. And the whole point was never that I wanted to retire early, is that I wanted to have the option to retire early, basically to be financially free early so that I can then either, continue working on what I was working, work on something else, work on whatever I want. And so in that sense, it basically went according to plan. And it's one of those things where, in my say mid to late 20s, I was a little bit kind of undershooting that goal from what I wanted. Whereas by the time I got to my early 30s, I had overshot that goal. So it's one of those things. I think it's even like a Bill Gates quote where it's like people overestimate what they can do in like a week, but they underestimate what they can do in 10 years, right? So it's the way that the mind works. So it's like we don't give ourselves enough credit for how big we can do something in 5 or 10 years, whereas we always overestimate what we can do in a short period of time. And so basically by catching up and ramping up, I kind of actually exceeded my goal. I thought maybe by my late 30s or I'd be more independent, whereas I kind of got it into that early to mid 30s.
Yeah, I'm really bad at that. I'm very hard on myself in the short term, and then I look back after a year and I'm like, it actually kind of compounded up to where you maybe made some gains. But I had a guest in here named James Clear who has a book called Atomic Habits, and he kind of goes through this. If you can improve by 1%, a week, it doesn't feel like much, but compounded over a year, you're up 50, 60, 70%. And again, not necessarily even on your investments, but a personal habit or some other goal. So yeah, as humans, we're sometimes a little myopic in how we're thinking, and maybe even investing, which maybe brings us right into this point that you talk recently about and a lot about of just inflation. Because if people are listening, they might be saying, well, then I save my money, and that's probably the most advanced most people's personal finance is I put some extra money in my fiat currency in the bank, and that's all well and good until maybe you start to consider this concept of inflation, which I think luckily in the last 18 months has got a lot more airtime. I actually have my 17-year-old daughter in here talking about money, and we talked about Bitcoin, and she asked some really good questions like, how come the central banks can keep printing money forever? That doesn't sound right. It was strange, that even a 17-year-old was asking some really good questions. Let's talk about inflation. How do you first have that conversation with people to even understand what it is? Because I think it was Terence McKenna that said, I don't know who discovered water, but it definitely wasn't a fish. And sometimes we're in the middle of this and it's hard to see what you're in.
I find that a picture is worth 1,000 words. And so a chart just showing what something cost over a century, for example, tells you almost everything you need to know about inflation. And, sometimes I try to think back to when I started saving and investing, I was like a little kid. I was like, we basically, I was impoverished when I was a child, and then I moved in with my father, and we were, more comfortable. And I started saving and investing when I was not even 10 yet. And I shifted into, in addition to just, saving cash from birthday presents and stuff, I shifted into like little tiny silver coins, and eventually like little fractional ounce gold coins. And somewhere along the way, I knew what inflation was. I think it's because I was always mathematically inclined. And so I just kind of, it's something that just kind of randomly clicked with me. But I think for a lot of people, it's showing them a chart of inflation over time. And going back to my father's example of how he saved, but he never compounded, right? He always was financially secure, but never, I guess, abundant, is because he would save for things, but he didn't understand investing at all. And back then, you could at least earn a yield that exceeded inflation, but it was still maybe smaller than people think. So people think that they're earning 5 or 6% from the bank, but inflation's 3%. They're earning like half of what they think they are in terms of actual purchasing power. And then you're also, if that inflation metric is understated, actually inflation's still higher, then maybe they're not even saving that much or earning that much. And so I think it's one of those things where people really need to go look at these long-term charts and also just run the math, especially in the modern times where interest rates are below the inflation rate in most countries, especially most developed countries. Saving is a very challenging thing for people because you're constantly adding more ice to like a hot area that's just melting constantly. So it's like this, you're on a treadmill rather than a long-term compounding approach with that.
Yeah, and times have really changed. I mean, I think when I was a kid, well, you had what, in the 80s, and you had double-digit interest rates, double-digit inflation. When I started on Wall Street in 93, I remember Fed funds overnight rates were 3%, long bond was 6%, and now these days, you're much, much lower than that. And like you said, in most developed countries, inflation now over interest rates. I'm going to put up a chart here that you posted on Twitter a couple days ago where you just said the inflation report came in hot this morning at 6.2%. And you can see this kind of big increase of inflation, I think, in 2001. And I guess this is one of the many charts that you show to a lot of your followers. What should people pay attention to in this chart? What's the thing that really struck out for you?
Well, I mean, overall, the issue is we're seeing basically a giant disconnect between inflation and rates. And so, the United States right now, it's 6.2% official CPI, probably higher if you measure it in the way it used to be measured, while rates are near zero in just about every developed country. And the same problem is throughout Europe at the current time. The same problem is in most places. And so that, one of the key takeaways is that basically the world's now entering an inflationary spike that we've not seen for a period of time. And of course, there's different debates about how persistent it is going to be and how sticky it is, how kind of what's causing it. But overall, it's something that for a while, for the past couple of decades, you could kind of get away with not following inflation. Um, whereas now, because there's such a disconnect between rates and inflation, is something that every person has to know. Because if you're simply failing to grow your wealth, then that's one thing. But if you're actively losing purchasing power with your money in the bank at a notable rate, that's a more serious problem that people have to pay attention to.
What's the reaction to most of the people you meet in public and the people that subscribe to your newsletters? I mean, do they kind of get it right away? Do they need a few ways to convince them? And then after that, what's their next steps once they see this actually happening?
I think, I mean, there's a big disconnect between my readership and people on the street, right? So my readership is self-selecting towards people that are already interested in the subject and generally know about the subject. And so they get it. It's something I cover quite a bit. Whereas, a lot of people I run into, they just, they don't fully grasp what it means to, have that deep of a negative yield, right? So they kind of assume that it's I would describe it as recency bias. So as humans, we often think that the last 5 years are going to tell us a lot about the next 5 years, or the last 10 years about the next 10 years, right? Things we assume some degree of stability. And so even though this past decade was a pretty bad one for savers, it was hard to notice because it wasn't too severe. And they assume that maybe the next decade is like that. They'll think I probably should invest, but I don't know how to. It's scary. They're worried about volatility, and especially with it is challenging because with stock valuation so high, especially in the U.S. and many places have very high home valuations, it is intimidating for investors to come in. And so they feel like they're stuck between a rock and a hard place. They're like, well, there's expensive assets. I don't understand. They're volatile. What if the market crashes? And then they're like, or I can just hold this melting ice cube. And many of them aren't fully aware of just how rapidly that ice cube melts.
Yeah, and it's really good that we're talking about this because people do ultimately have to make a decision because when you don't do anything, I guess you are deciding to kind of hold that ice cube. It's funny to me when I look at kind of older generations and how they kind of inherently understood what you did when you were a kid. My mom, she's 76 and she lives in San Diego, and she's bought rental properties her whole life, and that's how she survives. She rents those out. She paid off 30-year mortgages, Lynn, over 30 years, and now she has these assets. And strangely enough, my wife's mother in Bulgaria, she, we call her Baba. She's kind of old school, and if you really ask her where she puts her money, she's got it in gold, and she's got it maybe in dollars, and she has some properties, but she sure as hell doesn't keep it in a local currency there. And of course, there, more inflationary issues and devaluation issues, but it's interesting to look. There's always people around that kind of understand this from a core level, and that's where the smart money goes. Now, these days, it's maybe harder to do, especially for a younger generation. My daughter at 17 just owned her first asset, which is a piece of cryptocurrency. I don't think I owned an asset till I was in my 30s, because unless you owned real estate in the States, you never really would own an asset unless you went out of your way to get educated. Like you said, the choices are tricky out there. So if people are getting this right now and they're like, okay, I get it, inflation is something I should worry about, how do they start that journey into investing in something?
Probably the first thing is research it, right? So just research, stocks, precious metals, real estate, Bitcoin, these different asset classes. Right now, it's cash and bonds that are the ones that, historically you'd research how bonds work too, but right now bonds are in the same boat as cash, where they're rather poor investments. So basically start by researching some of those inflation protected assets. And the point you bring up about some people natively getting it's often based on their experiences, right? So anyone in the developed world that's old enough that it was aware during the 70s generally gets it. And for some people that even, they're always expected to come back in that magnitude. And they often for decades thought they had a more inflationary mindset. And sometimes it actually was even a setback for them when it came to investing. And whereas I think it's probably going to pay dividends in this type of environment. And people in emerging markets often get it because they're, those countries are more prone to currency problems, currency devaluations, high inflation, broken currency pegs, right? So like I have a friend in Egypt, and I think it was back in 2016 they broke a peg And so the Egyptian pound lost about half of its value practically overnight. So you wake up and your savings are cut in half in terms of purchasing power. And so there's this tendency to, shovel the currency into hard assets. Like basically they do a plan where they want to buy a house. They don't do 30-year fixed mortgages there, but they'll have like a 7-year payment plan, and you're kind of you're contributing to the construction of that house, and it's considered risky, but it's basically their main way to invest. You're getting into those harder assets. And so for many places, real estate's the go-to one because everybody can intuitively understand it, right? So I mean, we even kids play video games where you like build your own house, right? In your virtual world, you decorate it, you invest in it over time, right? If anything, people, kids learn more about finance from video games than they do from school because you have these in-game economies. You basically you collect gold and you can build your house and you can upgrade it to a stone house and you can invest in it over time. And so I think a starting point for a lot of people is to understand how real estate works and then go from there.
Yeah, don't get me started talking about the metaverse and play to pay and how that goes into DeFi. We'll get to that. And I've been having some of those conversations recently, and I bought a few Axes over the weekend, and I was playing with those too. So it's interesting to see where that's going. But I agree, that's the way a lot of people do learn about this, like Sims and stuff. They kind of see how that's built. How do you feel about inflation going forward? I actually had Jeff Booth here 2 weeks ago, and he wrote a whole book about inflation, deflation, actually before the crisis, kind of predicting what was going to happen. And Jeff breaks it down and says, look, this is something we've repeated on 80 to 120 year cycles where, we always seem to inflate our currency until there's a war or an overthrow period. And we've done it since the Roman times. And until we create something deflationary, which of course he goes and talks about Bitcoin, which we will talk about, it's going to be very hard to get out of that paradigm. Do you share the same views as Jeff does? Or do you think this is just about getting the central bank to just talk more to the public about what they're doing? What's your view going forward of how we solve this?
Yeah, so I have some reviews to him, and he's an acquaintance of mine. I'm a big fan of his work. So I would describe the inflation situation in a couple different ways. One is that over the long arc of human history, our technology is deflationary, right? So it used to be, someone would have to spend almost all their time working to get food, right? Um, and then we invented tools to make it so you have to work half your day to get food. And then we invented things like tractors. So, you could pay one person and that person could feed 10 people with the work they do. And so basically, if you look at, say, share of workers in agriculture, it was like, 80%, and it went down to like 1 or 2% in developed world because of better and better technology. And that applies to all sorts of other things, construction methods, obviously software and electronics and things like that. We get better and more efficient over time, and that pushes the price down of things in a vacuum, right? So a lot of things go down, say in terms of gold over time, and whereas because we have modern central banking, right? So we constantly inflate the money supply. We offset that natural deflationary pressure with an inflationary money supply, and so we end up getting some sort of in a good period, say, moderate inflation. So prices go up a little bit every year, every couple of years. But every few decades, because that system is inherently unstable, right? So when you can just print money, essentially, inevitably you run into a problem and then you just print a ton of money, and then the currency breaks. So if you look at the long arc of history, they've tried fiat currencies a number of times and they last for a period of time, but because they're inherently abusable, they eventually get abused and they break. And then it goes back to gold or other assets. And so over the past 50 years, we've been in basically an experiment. The first time in human history where the entire world was on a fiat currency standard. And it's been the longest and most sophisticated one by far, because modern technologies made it more workable. And in addition, they have certain guardrails that have kept these things going, in a semi-stable way for quite a long period of time. And so it's in some ways it's very impressive. It's one of those things that seems simple on the surface, but when you actually get into the geopolitics of how currencies work, all the way down to say the petrodollar and how that system functions, it's a very sophisticated system with guardrails and these long-term arrangements. But essentially, it's basically trying to offset this big deflationary force. Whereas if you go back to Jeff's argument, It's the idea that we should just let that deflation play out, that the world would be a much better place if we didn't structure our banking system around this idea of constant money supply growth, and instead let technology deflation, boost our purchasing power over time, reward savers rather than debtors, and kind of shift to that different type of economy.
And do you think that that's what we should do?
I think so. I mean, if you go and look back to, say, the second half of the 1800s, or the last 3 decades of the 1800s, that was a very good period for productivity growth, and you had deflation in many places, especially in the United States. Now there were some key things there. I mean, they had abundant land, for example, but you basically had a technology revolution with the internal combustion engine and electricity, and all these things throughout the developed world, and that translated into lower prices of things. So it wasn't rapidly offset by all that monetary inflation, and it wasn't a perfect time, but it shows that deflation is not the boogeyman that it necessarily is made out to be. I think what mixes people up is that generally in the current system, deflation only happens during recessions. So we call deflation bad. It kind of mixes up causality. And then two, because our current system is so debt based, it's the idea of constant debt growth, and basically consumerism and debt growth. In that system, deflation is bad, because when you have that much debt and then you get deflation, you can't service the debt. You need prices of things to keep going up to offset that debt. So in a highly debted system, which we have, it makes sense that people, assume deflation's bad, because in that niche circumstances, which is mostly what we're familiar with, it is. But in a healthier system with less debt in the system, that's more based on saving and capital, deflation is not the bad thing that it is, as it is in this current system.
And if you had to look at, U.S. monetary policy the last 100 years, or some of the decisions they've made, like you said, when you have the option of printing money, it's almost like that saying, absolute power corrupts absolutely. It's almost like there doesn't have to be a bad guy. And you can say that Nixon was the bad guy in 71, or FDR was the bad guy in 33, or whatever, when they stopped necessarily reporting the gold pieces. Or you can say last year, the massive printing of money during pandemic, there was bad people that did that. But you shouldn't look at it that way, in your opinion. Is it just something that's going to be abused over time, and it's ultimately a system that's not going to be able to be stable? Or were there certain of those points where we actually accelerated this thing breaking?
So I would describe it as an inherently unstable system, but the speed with which it unravels can vary greatly based on individual decision points. And I mean, going back to the Nixon example, one thing I pointed out is that that system was doomed from the 60s. And so, basically it already broke, essentially, and it was marked to market in 1971. And so Nixon was bad for all sorts of reasons, but that particular issue was, he was a small cog in that big machine that was set up all the way back in 1944 in the Bretton Woods system. And if I were to describe where I think in the modern era where central banking went wrong, is probably under the Greenspan era, and because that's when central banking policy started shifting more towards Wall Street rather than Main Street, right? So you had, for example, long-term capital management blew up, and Greenspan cut interest rates, even though the employment situation was great, right? So basically, you did a rate cut just for the markets rather than real Main Street, and that arguably led to the dot-com bubble. It certainly fueled it, it was one variable among many. And then in addition to the behaviors they did after the dot-com bubble, essentially led to the housing bubble. And so, we basically started a series of bubble formations. Whereas before that, they had a semi-stable environment. It's still an inherently unstable system, but it was being reasonably well managed. And so I would describe that kind of 90s period is where they could have made different choices, that would have made the system more stable. And now I find that they're kind of in that Nixon situation where the table's already set, right? So people often ask what I would do if I was the Fed chair, and my answer is I'd resign. Because I don't know what Powell should do. I can list things he shouldn't do, but essentially they trap themselves in a corner. By constantly lowering rates, they allowed so much debt accumulation, because by lowering rates, a company can take out more debt, and still be able to service it because the rates are so low. And the same thing for the government. And so when rates get that low, there's a ton of debt to GDP, and then they can never raise rates because it would blow everything up. Everything would go bankrupt. Unlike say the 70s, where Volcker was able to raise rates super high because debt as a percentage of GDP was very low. So it was painful to raise rates that high, but it didn't result in like every entity out there going insolvent. Whereas when debt is this high, that's what would happen if they raised rates to say above the inflation rate. So right now inflation is 6.2%. If they raise rates to 7%, the government would be paying trillions of dollars in annual interest. Vast, tons and tons of corporations would go bankrupt. And so they kind of trap themselves into that corner where they have to hold rates below the inflation rate and try to inflate that debt away. But that's how these fiat currency systems historically kind of start to unwind. And so they've kind of pushed this pretty as far as they can go, and now they're just doing damage control. And it's not a place I'd want to be in. And
so the last 18 months, they haven't had much of a choice than to lower rates and print just huge chunks of money. And then now once they do that, they're in an even worse situation.
Exactly. I mean, around the margins, there's things I would disagree with their actions. Like, I don't think they should buy corporate bonds. I don't think Japan should buy equities. Bank of Japan should buy equities. But the other thing is that they're essentially stuck. And it's something that a lot of people are surprised by what the central banks are doing. But for example, by looking at the long-term debt cycle, I was talking about this, over the past couple of years, this big disconnect between inflation and rates, and that we'd start to see some of these unusual policy actions because they've trapped themselves into a corner mathematically. There's too much debt for them to basically behave as you'd expect from the inflation levels.
Yeah, and I actually remember long-term capital crashing in '98. I'm showing my age a little bit, but when I was at Bankers Trust, they had just started forming, I think around 96, 95, and they were the hottest thing, right? All the talent was going out there, the big names, right? Like Jock Goodfriend, I think they had Myron Scholes out there or something. There was a chunk of capital and they levered it to high hell. Everybody wanted to do business with them from a banking perspective, and then nobody knew how much leverage they had. Obviously, they made massive bets on interest rate swaps, traditionally not a very volatile instrument. And then when they did pop, I think it was Russian crisis in '98, and then it all went wrong, right? And then they had to fill this hole. And like you said, the first time the Fed kind of decided, all right, it was kind of one of the early bailouts. They weren't really a bank, but it would have hurt the banks, right? So they made that call, like you said, right? And that put them up to then future subsequent bailouts and asset bubbles, is the way you see it.
Yep, they kept blowing it up. And in addition to organizing that bailout, now that was among bailouts. I mean, at least like they weren't able to keep operating. I mean, that fund was done. Yeah. But another thing they did besides the bailout was they cut interest rates, right? So even things that are not directly related to that big pool of capital that broke, basically the Asian financial crisis and the Russian financial crisis were the triggers for it. And then specifically, I think it was the Russian side that really messed up that fund. But the fact that they also cut interest rates for the entire economy based on a market event is basically a key thing. I mean, if you want to bring it back further, you can go back to the 1987 period. But I would say at least long-term capital management was the time where what a central bank focuses on changed.
Yeah, really good moment there. I want to get into Bitcoin, but before you do have some interesting IP around long-term debt cycles, and you look at kind of the 1940s and the 1970s. How would you explain that to people? Why is it important?
So if you start with the idea of a short-term business cycle or credit cycle, so after a recession happens, the economy's not that strong, but it starts to build up over time. People get more confident, then they start issuing more credit. So banks lend more. Companies are able to issue bonds. You build up debt in the system. You get into an economic boom, and eventually there's too much of that. There's malinvestment, and it pops. Often it's the central bank that pops it because they cut interest rates in the first place, and then they raise rates, and then they pop it. Or an external event could pop it. Could be a pandemic. Could be some sort of other external event. It could just kind of work itself over time because the malinvestment build up. But some way or another, you get a deleveraging event. And so in a perfect world, you deleverage all the bad debt and have the dust settle and then go on to the next cycle. But because of the incentives that we live in, obviously policymakers want to come in and they want to shorten that cycle, soften that deleveraging cycle. And so they cut interest rates, they do fiscal stimulus. And so if you look at, say, debt as a percentage of GDP over time, let's say in the corporate sector, you only partially deleverage. So you don't go back to the leverage you had in the beginning of that cycle as a percentage of GDP. You only partially deleverage, and then you start building up from there. And so when you string multiple of those cycles together, you get higher highs and higher lows in debt levels, and then you get lower highs and lower lows in interest rates. And so you string those together for a couple decades or a few decades, and you go all the way down to zero interest rates and extremely high debt levels, and then you're trapped. And so if we look back in history, we would call that a long-term debt cycle. So people often just think in these 5 to 10 year increments without realizing that they add up together, and then they have a bigger event. And that bigger event is generally a currency devaluation, kind of their only, quote unquote way out when that happens is that they hold interest rates below the inflation rate through yield curve control or financial repression, basically various ways to do that. And then savers and bondholders, basically anyone who owns those liabilities gets screwed. And the debtors basically get partially bailed out through inflation, and then they basically maintain that financial repression through a period until debt as a percentage of GDP is lower because you expanded nominal GDP so much, partially because of inflation, while holding those debts low and constantly devaluing them. And so if you go back to the 70s, we were not in that long-term debt cycle issue. We had other issues, right? So we had run out of gold to support the Bretton Woods system. The United States had peak oil. So oil production peaked in the United States in 1970, and we had to start importing it more from other countries. So you had the combination of a broken money system and a real world constraint on resources. So that classic inflationary event. But the one thing you did not have was high debt to GDP levels. So government debt to GDP was like 30%, partially because they already did decades of financial repression by that point from the 40s. And private debt was a little bit higher, but still on the low end in the past 100 years. And so they were able to combat inflation by raising rates. Whereas if you go all the way back to the 40s, it was a very different environment because you had the war spending and you had the large fiscal stimulus and all that. That was the only time, basically that developed countries had as high debt levels as they have now, right? So in the United States, the only other time we had 130% debt to GDP was World War II. Same thing for Europe. I mean, all the 20s, 30s, and 40s, those were the last time where they had debt as high as they have now. And the way that was handled was, in the 20s and 30s, they devalued their currency versus gold. And in the 40s, they did financial repression. So they held interest rates super low while inflation, averaged 6% for the 40s. It peaked in the double digits for periods of time. And they just basically inflated debt away. So if you were holding T-bills, for example, you lost about 40% of your purchasing power over a 9-year period from 1942 to 1951 or so. And so when that dust settles, if they thread the needle correctly, they've inflated enough debt away that they have lower debt to GDP levels, and then they can actually raise rates again and kind of start the next cycle. The problem is if you that's a very dangerous time for currencies because instead of devaluing 40%, you can overshoot that and you risk a much more even more severe currency devaluation than that. So my whole thesis for the past couple of years is that because interest rates are zero, because debt's so high, they've entered a long-term debt cycle where even when we get inflation, they're just not going to be able to raise rates by a meaningful enough amount. And so savers and bondholders are at risk of devaluation.
Gosh, it's a bit of a bleak future, Lynn, when I think about it. What happens in the next 10 years, do you think, honestly?
I mean, so I think the base case is that inflation will be higher than interest rates for most of that time. Now, there could be occasional deflationary shocks. Nothing's in a straight line. If you look at inflation in the 40s or the 70s, it wasn't a straight line. Now, partially that was because of price and wage controls, but it's also just because there's ebbs and flows of fiscal spending and bank lending and things like that. But I think overall the 2020s are going to be more inflationary than the 2010s. It's hard to say how much because that depends on certain choices, and that rates will not reflect that inflation level. So it'd basically be a decade of financial repression. And so overall, I think that the main takeaway is to hold harder assets. And then as it works out geopolitically, the U.S. and China and Europe, I mean that all remains to be seen. That's hard to predict. But I think the event I'm focusing on is these currency problems.
So Jeff Booth concluded at the end of our interview that Bitcoin could save humanity. What does Lynn Alden think?
I certainly think it's one of the most attractive assets to hold in this type of environment, because you're contrasting a scarce money, so something that is credibly not going to go over 21 million units, and of course it's divisible. But the point is, if you own a certain fraction of Bitcoin, you own a certain percentage of fully diluted Bitcoin, and no one can shrink your percentage of that pie. Whereas, for example, if you hold X number of dollars and there's Y number of dollars in existence, Y is going to keep increasing. So unless you constantly increase your number of dollars at that same rate, you're going to have a smaller percentage of those dollars that exist. And so when you compare and contrast an inflating currency with yields below the inflation rate compared to a stable currency, one that has a hard cap, and that if anything is deflationary because occasionally someone loses their coins, although it doesn't happen as much as it did in the past, it's a much more attractive, at least a store of value. And then in some places, or for some types of people, becomes an effective medium of exchange as well. And so it's certainly an asset that I think it makes sense for a lot of people to want to hold. In addition, unlike say securities, you can self-custody it, right? So if you own a stock certificate or a bond certificate, or if you have cash in the bank, that's essentially someone else's liability, and you're being held on your behalf. You're on the ledger that someone else controls. Whereas there are very few things that you can self-custody. Property is kind of a mixed one because you can't move it, right? So you can hold the deed, but you can't move it. You can say it's not even necessarily really yours in that sense. Whereas, say, gold coins and Bitcoins are things that someone can actually physically custody and have. And basically you can move them. And the advantage of Bitcoin is that, you can safely self-custody large amounts of it because you can do things like multi-signature solutions and things like that. And two, it's the most mobile. So, if anyone tried to bring gold through an airport, for example, good luck. If they're trying to, and people in the United States or the UK or other places in Europe might say, well, why would anyone want to do that? We have to think more broadly about 7 or 8 billion people in the world, and how many people, the majority of them live in emerging markets where they've had currency problems and where they want to be able to self-custody assets. Many of them live in authoritarian regimes where they're subject to confiscation. And so a self-custodied asset that depending on how much you have, can be custodied in different ways. You can hold it on a free mobile wallet. You can hold it in a hardware wallet. You can hold it in a more secure multi-signature cold storage solution. There are different ways to hold it. But the point is, you have this access that you can go anywhere in the world and still access it. You can send it to anyone in the world, and there's no ability to stop it. And so that's a really powerful technology. And then, of course, compared to other cryptos, it's the one that has the most credible decentralization. So there's no kind of group that can change the money supply or permission or try to permission the transaction. This is the one that's the most auditable, the one of the two widest network effects in the space, and by far the most secure in that sense.
And what's been your relationship with Bitcoin? Because I think it first came on your radar back in 2017, but you didn't really go in and invest yourself until 2020. Am I right with that? And what was your learning curve like? Because I had Max Kaiser in my studio here in 2013 screaming about Bitcoin. I just met him after bouncing around on Twitter, and that's the first time I heard of it. I bought a couple. I lost them on a mobile wallet. And then I had Andreas Antonopoulos come here in 15 and 17 and 19 talking about the future of money. And Andreas is amazing, but I still didn't really get it until really this year where I finally got it. It took me a while. What was your journey like?
Mine was similar. Basically, I think it's common that you need a couple different touch points before you get it. And so mine, Max was super early. And the funny thing is, like, I had heard about it.
To continue watching the rest of the episode for free, visit our website, londonreal.tv, or click the link in the description below.